This podcast thanks to OFX, the experts in global money transfer. Transfer funds 24/7 with no hidden fees. The smart money's on the smart move. Go to OFX.com.
Great to have your company here on Money News right across the country. Of course, there was a rebound, as I said earlier, in the Australian stock market today that followed the rebound in Wall Street. It really was all over the place last night. And if you look at the charts of the volatility index, the indice, the VIX index is really, really significant. So it's almost gone from no volatility to maximum volatility. Well, amongst the stocks that actually did improve here in Australia, one of the big winners, Rio Tinto shares up almost 4%, $78.31. But then, to coincide with the opening of London, where there's got a joint listing, a dual listing, Rio Tinto announced a massive profit. What it is, a record full-year dividend. It's paying out $5.2 billion. It's also going to have an additional share buyback of $1 billion. This is just to show you the power of this particular company when it starts to generate cash, when coal prices and iron ore prices go in their favour. But the other one also is that during this year, Rio Tinto has been able to pay back, well, the best part of around about $7 billion, $5.7 billion US. So it's been able to cut its debts from $9.5 billion US down to $3.8 billion. So that is an astonishing amount of cash that's being generated out of this business. And you can see some goes to the shareholders. A lot of it pays off debt. And some of it also goes back into basically buying back its own shares. Well, just fresh from talking to investors, Chris Lynch is the Chief Financial Officer of Rio Tinto. He's on the line right now. Many thanks for your time, Chris.
Good day, Ross. How are you?
Really well, thank you. Thanks so much for your time. Is this really just one of those stellar years where really the stars aligned for Rio Tinto? You had the commodity prices going the right way, you had the operations and the cost savings going the right way, and as a result, the cash flow was able to drop to the bottom line?
Pretty much, Ross. I think the key, we have put ourselves in the path of being able to take advantage of strong prices. So if you look at these results, it is a great set of outcomes for the shareholder. As you said, a record dividend of $5.2 billion. And all up cash returns to shareholders of $9.7 billion declared or pertaining to the 2017 year. $5.2 billion of that in the dividend, and then $2.5 billion from the coal and allied proceeds that we're returning, some last year in the limited off-market buyback, and another $1.9 billion going through this year in the PLC buyback, and then another $2 billion of buybacks. So last year we announced, at the half year, we announced an extra $1 billion of share buybacks, and this morning we're announcing another $1 billion of buybacks. So all up, $9.7 billion going either as dividends or share buybacks over the course of the pertaining to the 2017 year.
Rio Tinto over the years has been noted for its iron ore assets, for its aluminium assets, bauxite assets as well, also owning some of the very best coal mines in the world. Given the fact that you have sold some of those coal operations, going longer term, what's the view of the company in regards to its coal investments? Does coal have a future, a viable future in Australian mining, and certainly from Rio Tinto's point of view?
Well, I think the Australian coal assets, we as you say, we sold the coal and allied assets. They're very good quality coal, and that coal's got a place in the global market. And I think, it's impossible for the world to displace all the coal that is mined and used for power generation in the main. The other area of coal, obviously, is the met coal, and that's always going to have a role. For as long as steel is relevant, then so will met coal be relevant. So I think, coal's definitely got a part to play in the future. The key issue really is around, where is it going to be burned? And currently, China burns in excess of 3 billion tonnes of coal per annum. So it's not going to be displaced. It won't have the same growth profile that other energy sources might have, but it's definitely not going to be displaced. And
is really the strategy of Rio Tinto, say, for example, to sort of try and tilt your portfolio away from coal, particularly the energy-burning coal assets, to actually tilt it more towards other energy sources that may be more lucrative and have stronger growth paths in the future?
Well, Ross, we've got a small portfolio in uranium, but both of those mines are approaching the end of their life. So the ERA mine you'd be aware of in the Territory, that ceases operations in 2021 and it's got to be remediated by 2026. So and then the Rossing uranium deposit in Namibia. But again, that's a pretty small and approaching end of sort of end of the reign there. But the key issue from our point of view, our focus is really the iron ore, the copper, the aluminium portfolio. And you know, there are diamonds we've got approaching the end of their lives too. But we're interested in a variety of commodities. But the energy suite is pretty much, not really that prominent in our thinking at this stage.
Just tell me about the material financial costs that you talked about in the balance sheet today and with these results in regards to ongoing scandals, lawsuits that have taken place in both Guinea and Mozambique. There have been investigations there. When you say material financial cost, what sort of numbers are around that?
Oh, Ross, I can't comment on any of the regulatory review type issues that you refer to, but and it's not. There aren't material costs in this set of results. The wording in there is really just in the event that everything went pear-shaped in some way, shape or form, then there's potential for cost. But at this stage, we've got no line of sight to anything, and we've got no capacity to determine outcome or quantum.
Given the fact also right now that there's been attention, even the last few days, placed upon the trajectory of interest rates, especially in the United States, because Rio Tinto reports in US dollars right the way through, is the idea of trying to get as much debt out of your balance sheet to become as strong financially as you possibly can, is that trying to make the portfolio, the actual balance sheet, more risk-averse in the event that there were some downturn down the track?
Ross, I think the key thing is it's less a worry about near-term gyrations in interest rates, but just under sort of having a fundamental belief that a strong balance sheet is a very strong thing to have in this industry. It's a cyclical industry, and the strong balance sheet gives you what I talk about as the 3 R's. It gives you the robustness against volatility. It gives you the capacity for returns throughout the cycle. And it gives you a readiness to take advantage of opportunities. So those robust returns and readiness are really the sort of the key strengths we see about a strong balance sheet. So it's been that overriding philosophy. We've been working on strengthening the balance sheet over the last 4 or 5 years, and that's we're in great shape there as we speak. And as you rightly point out, obviously the gyrations in the market overnight start to introduce some of the conversations about interest rates, but that's less in our thinking. I think our gross debt's about $15 billion, our net debt 3.8. So we're not overly exposed to interest.
Just the final one, because you watch this pretty closely. China clearly is very much important to Australia's economic future. It's important to Rio Tinto's economic future, especially with iron ore sales. Given the fact that you had underlying earnings from your iron ore business of $6.7 billion US, give or take, compared with $4.6 billion last year. Can you see really, again, everybody talks about can China, the growth keep on going, all that type of story. As you project forward, because you've got a plan for the mines, plan for the growth in those mines, can you really see that the demand for iron ore is going to continue as strongly out of China as it has over the past decade?
Yeah, look, I think there's a good, strong underpin for demand. I think what you're going to see in China is a migration in the economy from the share of growth that's going to infrastructure and construction will probably sort of start to be a lesser share of the overall growth. And you'll see more of the growth going to consumption and services and those types of issues. So I think that's fully understandable for this age and stage of the maturity of the growth cycle that's sort of starting to emerge. But we see a strong underpin. And the other thing that's happening in China is the environmental push in China is very real, and it's immediate, and it's happening as we speak. I mean, so an immediate manifestation of that are the winter curtailments in the aluminium industry, in the steel making. There's a rationalisation of the state-owned enterprises going on with, the more efficient and the cleaner producers are being encouraged, and the lower quality producers are being discouraged. And that you're seeing that in the demand for the higher quality raw material inputs. And so the discount for the lower grade materials is now quite wide. It's widened out dramatically over the last 12 or 18 months. and it's now, it's in the 30-40% sort of range, the discount from 62% iron to 58% by way of example. So that's a very real trend.